But isn't bank already making it harder for people to work towards it?
Yeah, and see that's true. So this is the biggest impact that I see on the industry now.
How would the investment go from 2026?
See, again, it depends on a lot of things. What sort of borrowing you have, what is your current portfolio structure. So there are a lot of things. Then
What about the rentals? Is it going to go push up now? Since
in the short term, definitely the rental pressure is real and the risk is real.
100%. Like, one, the property prices are high. Second, you don't get negative gearing. Third, you can't borrow as much as you can. Hello, and welcome to another episode of Inspire from Reality. At Inspire from Reality, we always bring some inspiring stories, some people, those who have gone through some journey. And as you know, as we are growing up in our podcast, we would love some subscribe and like from you. We are so thankful that you're watching us, and we have been thankful for all your likes and comments so far. But as you give us a like and comment and follow our guest on their journey, it helps them to grow. It helps us to grow too. With that, let me start our winter series. This winter, we are bringing a little bit of chaos and a little bit of solution to the chaos. No, I'm not talking about the war. Come on, everybody has forgotten what is happening in the war. But there is another chaos which is happening in Australia's own soil. Have you been thinking about all this negative gearing and CGT and the trust thing that has come up? I know there is no one who is not thinking of. Be it a high earner income, be it a payee, be it a trust builder, be it an investor or a new home buyer. Everybody is confused right now. What do we do? And to get that solution, what do you do? Right? When you don't know what to do, and trust me, most of us don't know what to do. That's why there are certain people in this country, those who help for us, like people, like investors, like buying home, they help us to understand what should be our strategy, what was our strategy, and what changed in this world. Let's welcome Ankit. This is Ankit's second time in our podcast, and we invited him again because we wanted solution to all the chaos. Ankit from ValueNest. Welcome, Ankit.
Thank you again, Alka, for having me here. I think it's great to share the information that I have, the research that we have done with all the viewers and the listeners. So yeah, thank you again.
And Ankit, in the last podcast when you were here, you told that you do research.
Yes.
And you learn things and you love to go dig down depth into it. And that's why we have you here.
Yes.
And I think it's the first time in my podcast anybody is going to solve this chaos right now. What happened? What happened? Just everything went like there were strategies. People have been working on that for last 10 years, thinking about their retirement.
Yes.
But everything just changed. Give me a gist. What just happened?
Yeah, actually, I think there were a lot of conversations around this budget from last 6-7 months. Different people, different banks, economists were predicting different things. And it was a bit expected, but again, it came as a shock for a lot of us. But see, as when I heard first time all this in the news on 12th of May, so it was difficult to digest. Not only for me, everyone was thinking, how is this going to span out in the long term? But as we did the research later on, over the last few days, we are seeing that, yes, there are changes. But then if structuring of your portfolio or buying the properties is done correctly, or, it requires more of an accountant engagement now, more structuring, more, strategic buying is required at this stage now. So if that is done, then you can still overcome these, tax changes. So I'll brief you about what actually has happened. So the two major changes that have come up after the budget is the first one is around the negative gearing. So all the established properties, if you buy after the announcement of the budget, that is after 7:30 p.m. on 12th of May 2026, any established property will not be getting any negative gearing benefits. So before this, what happened is like, for example, if I buy a property and I'm having a rental loss of say $15,000 every year, I can offset that against my salary and get some of the tax deductions depending on how much I earn and in what sort of tax bracket I fall. But now you cannot get those negative gearing benefits. So this impacts your cash flows and also your borrowing a lot. So that is the first change. Second one is around the CGT. So that is capital gains tax. Until now, or until the budget announcement, we were able to get 50% discount on our capital gains by after selling a property. Now going forward after 12th May for all the established properties, there's a different model which is called cost-based indexation model that has come into place. So the 50% CGT discount model has been slashed for the established properties only.
This cost-based index model, is it against the inflation? Like looking at the inflation
Yes.
and the cost rising, you can then...
Yes. So how this works is like, say you buy an 800K property. In the earlier model, 10 years down the line, if you sell that property, say $1.5 million, so your gain is 700K, right? In the earlier model, you get a 50% discount on the gains. So 350K is discounted, and on the remaining 350K, you pay a tax depending on your income bracket. Now, what is happening is, say a similar scenario, 800K property, you sell it at $1.5 million. So it will be adjusted based on the CPI or the cost-based indexation. So RBA's long-term inflation rate sits somewhere around 2.5%. So based on that, an 800K property after 10 years would be somewhere around $1,024,000. So that is a sort of discount you're getting here. So you will be taxed after, so your property price was 800K, you get a discount based on the indexation model. Now property price is 1024K. Your gain sits around 476K now. So you will be taxed on 476K, which is 126K more than the existing model. Right? Now, there are different scenarios to this, which we will discuss later. I think I have got a table, a detailed sort of scenario which we can show to the viewers to understand how this will look like in the long term. Yeah.
Wow.
But that's the high level summary of it.
There is so much of things to think because it was simple, it was easy,
Yes.
and it was structured. So what happened with the trust? Because we have always thought of investing to trust, keeping yourself safe, so many things. But then trust being having tax of 30% straight. So how does that play into the picture now?
See, in terms of trust, I don't see a lot of difference here. Earlier, the trusts or the companies used to pay a tax of 25%. Now it will be 30% straight. In terms of negative gearing, trusts never got any benefits of negative gearing, so that doesn't impact the trusts. So, and again, why people used to invest in trust was, somewhere related to your borrowing structures, to scaling your portfolio. So, and in the long term, I see that there's not a lot of impact to the trust. If you see about the SMSF, there's still no changes to SMSF. So that is still, a great way of investing.
Isn't this, so the negative gearing thing is going to be into the picture in 2028, right?
No, it's getting implemented from 1st July 2027.
2027, which is next year.
Which is next year,
But
yeah.
I heard that in Macquarie Bank has started also saying that we won't be giving that much of borrowing anymore because
Yes.
that negative gearing is taken up. But isn't bank already making it harder for people to work
Yes.
towards it?
Yeah, and see, that's true. So this is the biggest impact that I see on the industry now. Now, earlier when you go and buy a property under your personal name, banks used to consider the negative gearing as your income because, after when you fill in the returns, you will be getting that money in your pocket. So banks consider that as your cash flow, and your borrowing is calculated based on that. But now that the banks have said they will not be considering negative gearing as your income, so that has, will substantially reduce the borrowing power. So basically, if someone is looking to buy a property or has an approval to buy a property of $1 million, he is sitting somewhere around 850K of approval now. So you just see 15% loss in your borrowing, almost 150K. Now, it takes you out of a lot of quality markets.
100%.
And that is, I think, sorry to interrupt. So that is, one of the impacts that we might see going forward in certain locations. So, yeah.
Yeah, 100%. Like, one, the property prices are high.
Yes.
Second, you don't get negative gearing. Third, you can't borrow as much as you can. So it's going to create lot of issue for people, those who are self-investing themselves, because now they don't have any idea how to structure it, right?
Yes,
So
correct.
you must be giving already planning solution for your existing clients and
Yes.
being on phone, talking to them and planning out. So tell me, how are you planning for your existing client already? Client, those will come, they will come with a new plan.
Yeah.
But for your existing client, how did you restructure them, or what did you speak to them, and what did you tell to them?
See, I think last couple of weeks have been about educating everyone who's trying to get into the market or who is already in the market. See, for now, one good thing that has happened, that is grandfathering. So, which means that if you already have an existing asset under your name or trust or anything, like it has not changed, nothing has changed, you will still get the negative gearing benefits, you are still going to get that 50% CGT discount. So for existing investors, nothing has changed. In terms of the CGT, what's going to happen is until 1st of July 2027, you will be taxed based on the 50% CGT model. After that, any gain in your property is going to be taxed based on the indexation model. So, but then overall, I would say that you are still protected if you already own an asset. In fact, if you were under a contract before 12th of May 7:30 and you were waiting for settlement, you are still protected and you will be still taxed based on the old rules. So that's one thing. Another thing that has happened is like, and it is a very deliberate decision, I would say. Government wants to invest or focus more on the new builds and the supply. So all the new builds, the houses which are new, which are off the plan, house and land packages, will be still able to utilize the old benefits. So there's no changes for them. They can still claim negative gearing. They can still utilize either the 50% discount model or the cost-based indexation. So they will have a choice when they sell the property.
So isn't it going to put their price very high right now?
Uh,
Going to push the price very high for anyone who is entering the market, for them to, because mostly people, those who enter the market, they go for new build,
Yeah.
and mostly investors used to go for the old builds,
Yes.
right? So isn't it going to give a big shock to the people who want to enter the market?
Yeah. So now see, when we talk about the market impact, the way I see is, though you are getting a lot of discounts, or I wouldn't say a lot of discounts, but though you are getting all the old benefits with the house and land packages, you can still claim negative gearing. But we are seeing the price rises already in the lands, and construction costs are already going high. So the new builds are not going to come cheaper. They will be at a premium price already. In terms of established properties, I don't see, if you are still buying, it will be more about, getting decent rental yields. The properties which are heavily negatively geared, and these are the markets which might face some issues. So, and I'm talking about the good markets like Sydney market, where there's already not a lot of investor activity, and this is a very heavily negatively geared market. So these sort of markets might face a slight slowdown or a stabilization for the next year or so, I would say. But then again, there's a boom that's going to happen. The market shift happens when these sort of things change. So people will be going more towards affordable areas with higher rental yields, like Tasmania, like regional Queensland. So that's what we are seeing, and we are going to see in next few months, I would say.
So do you think there will be a shift to positive cash flow now?
Yes, definitely.
Because everybody would like to have that more cash in their pocket. Why lose the money if you're not getting anything out of the tax?
Yes. So see, the major impact is not for the long term. If you are keeping the property long term and if you can still hold it, manage the cost, then it's okay for you. But then this impacts your cash flow. Holding a property now, it will become more difficult. So people might or will definitely go towards positive geared properties. So we will see a change in gears, where people might go for co-living properties, positive yield properties. So that's something which is gonna drive the market in over the next few years.
And commercial too? Do you see a shift to commercial?
See, again, that's a different sort of scenario. We generally look into only residential properties, but commercial is mostly for the cash flow play. Overall mechanics, overall fundamentals of the property investing is still about capital growth. If someone is investing in properties only for the tax returns, then they are the ones who are poorly impacted. But if you are still thinking long term and if you want to still get the actual benefits, which is through compounding capital growth, then that doesn't change. That still remains the same.
So let's say high earner with 47 cents per dollar is looking to build his portfolio.
Yeah.
How would the investment go from 2026 forward?
See, again, it depends on a lot of things. What sort of borrowing you have, what is your current portfolio structure. So there are a lot of things then, but in general, when the structuring comes, my recommendation is, when you're buying your first asset, if you still have borrowing and you can get a borrowing of 2 to 3 properties, then the first asset should be for negative gearing or to basically make sure your cash flow is positive. So you should go for the new builds as a first property, which is always good, which especially from 2026 you will get some sort of tax return as well. With that, going forward, you can start investing using different structures. Again, it depends on your borrowing and individual circumstances, because I see now the investments through trust would increase. On the contrary, the banks are making the lending tight through trust, but then this is another way you can structure a portfolio.
And what about the rentals? Is it going to go push up now since so many things? Any prediction on rental that you can think?
Yes, I am definitely seeing the rental market to go up. The reason is, see, investors might be now more focused on new builds. So the established markets where there is already scarcity of the rental properties, where there's already a supply shortage. In those markets, if investors are not going and most of the properties are being bought by the owner occupiers, then there is, we are seeing that in these markets, the stock on market for rental or even for is less than 1%. So if these markets are tight, there is less investor activity, then there will be even less rental properties and will push the rents higher. So in the short term, I really see that this is the real pressure. The rental pressure is real and it will go up, unless, as per government, if they they can make sure that the supply is their supply is not a constraint anymore, the supply is not challenged anymore. There are a lot of houses being built with which, by a lot of measures, I don't see happening in the short term. So in the short term, definitely the rental pressure is real and the risk is real.
Wow.
Yeah.
Okay, give me a real life scenario. Just say, let's say Michael is a person, okay, as going to is going to buy a property in 2026. Over 10 years, what do we see? How do we see that?
All right. So I think I've done some numbers here. I'll run you through these numbers.
Yes, and we'll put this on the screen when you are running. We'll put this on the side of the screen so you will understand what he's saying.
Yeah. So now, like you said, let's meet Michael. So Michael is buys an established property in 2026. Now let's see how this property sits in a 10-year horizon. So Michael, say, is 38 years old and he's earning 180K per annum. So he falls in the highest marginal tax bracket, that is 47%. Now Michael purchases an investment property at 800K under his personal name. And this property is purchased around September 2026. So basically that is after the budget night. The loan is 640K, so which is 80% LVR at an interest rate of 6.5%. Annual interest costs for Michael is around 41,600 per annum. And the rental from that property is say 600 per week, which is 31,200 per annum. Other holding costs, which includes rates, insurance, property management, and other maintenance costs, let's assume that to be $8,000 per annum, which is sort of very realistic. Now, annual rental loss for Michael here is 18,400 per annum, which is basically interest plus holding cost minus your rental. So it comes down to be around 18,400 per annum as a holding cost for your property. Now let's say Michael decides to sell the property after 10 years. So let's assume, based on the Australian data for long-term property grows between 5 to 6% every year. So we are assuming a 5.5% growth per annum. The property sale price sits around $1.36 million. Now here the CPI assumption is 2.5%, which is what the RBA long-term target remains. Now let's discuss both the changes one by one. So first one is negative gearing. What happens in the old rules and what happens in the new rules. So Now the annual rental loss is same for both, like $18,400. Uh, Now deductible against salary, yes. Against the old rules, you get a full deduction against your income. With the new rules, you do not get any deduction. But a point to note here is your rental losses are quarantined, which I will explain how that works. Now, since Michael falls under the 47% tax bracket, he will be getting a refund when he lodges his tax return of $8,648. So now this property costs, the holding cost for the property is around $9,700 for Michael. However, if we talk about the new rules, he is not able to offset any of his losses with his salary income. So the holding cost remains the same, which is $18,400. Now this is a big impact to anyone who is cash poor, who still have issues with the cash flow. So this is the most important thing when you are buying a property. You need to look into that stress testing has to be done, that whether you can afford a property in the long term or not. Are you able to cover the cost of the property? So that's something to look into. Now these losses under the new rules over the 10-year period will be around $86,500. So that's a huge chunk when you talk about the long term. Now let's come back to the CGT thing, how that is gonna work under old rules and new rules with the same scenario. So Michael got a property of 800K and he sold it for 1360K. So the nominal tax gain, capital gain here is 560K. Now let's talk about what happens under the 50% CGT discount. So 560K, you get a 50% discount and you are taxed on 280K. Simple and straight. At marginal tax rate of 47%, Michael will be paying 131K as a tax when he sells the property. Simple and straight. Now, let's see what happens with the CPI adjustment. So 560K was your nominal capital gains tax with the 2.5% indexation. Now the property after 10 years would be somewhere around 1024K. So you are taxed at 336K now. Now, the good thing here is that all the rental losses you had over the last 10 years, so 18,400 per year, which is around 184K, that was quarantined. So what that means is now you can offset all your rental losses when you sell your property against the capital gains tax. So from that 336K, 184K goes out and you are taxed at 152K. Right now, at a marginal 47% tax rate, you have to pay $71,440 of tax, which is less than what you were paying in the existing model or the old model. However, when we see the entire scenario of the holding cost of the property and the capital gain tax, you are still paying more. So Michael is paying 131K as a CGT under the existing or the old model. Under the new model, he's paying 157K, which includes your CGT as well as your holding cost. So ideally, see, over the long term, what happens, the profit that you made on the property, 800K property, Michael made a profit of 428K over the long term for 10 years, which is 2.7%, 2.7 times of return on your investment, which was 160K to buy a 800K property. On the contrary, with the new rules, he's paying 401. He's getting a profit of 401K, which is around $27,000 less than he would have got in the old rules. So if you see the entire journey over the long term, you are still making good amount of profit, 20-30,000. It's okay. I would say over the long term, it doesn't matter. The main thing that has happened here is the cash flow position. So if you are able to hold the properties, if you are able to sustain that cash flow, the negatively geared properties, it's okay. But then that is something which needs to be looked into and strategized structurally now. Sitting with an accountant before buying any property under which structure, that is more important than ever now.
Yes. So with obviously every time there is a change,
Yes.
new structure, new process, new things comes up, and it goes. Then it becomes normal norm.
Yes, that's right. Yeah. Because see, our fundamental game, fundamental reason of property investing is in Australia is making money, getting rich, make sure we are getting some passive income in the long term, or we can retire early. So what is the option if you don't do this? Are you gonna just think that, oh, I have to pay more tax, I should stop investing? Is that the solution? No, right?
Because Australia don't have anything else.
Your profits are reduced by maybe 1 or 2%, right? But that doesn't stop you from investing.
Right.
Yeah. So again, like investing with the right structure and the right strategy will be more important here if you actually want to scale and do get something, build basically a wealth out of property.
100%. And as I see this, it's more about wealth shifting now.
Yes.
Then it's like wealth accumulators were there, those who understood the market. Then there were a few people those were scared to enter the market.
Yeah.
I think there's a wealth shift now. Let's see how it goes.
Yeah, I mean, again, it's about the market shift that happens, and every new change that comes up. We saw that COVID came. People thought that property market is going to crash. That did not happen. Instead, the market shift happened.
Yep.
Instead of buying in Sydney, Melbourne, people started buying in cheaper areas like Queens, Brisbane, Perth. Perth was like 300, 400K. Now it's sitting around $1 million. So now again, that market shift is happening. Areas with the higher rental yields like Tasmania, Darwin, people will move towards there because of the cash flow reasons.
Yeah.
But that doesn't stop, anyone from investing, and that should not happen because the fundamentals remains the same.
Yeah, about that property thing that we just spoke, Ankit. One thing which came into my site yesterday was when I was going through news, is the eastern suburbs in Sydney has crashed by 26%. And Parramatta has crashed by 17%. What does that mean? Like, is it because of these things people are scared and this is the hype, it is happening now before the dust settle down?
Yeah, definitely. See, like I mentioned, higher markets above $1 million, $1.2 million are definitely seeing, I would not say a crash, I would say a moderation, because these are very high markets. And first thing that has happened is borrowing has gone down. Now, major banks have already told that even if you have a pre-approval, they are not going to, consider negative gearing on the pre-approval. Still, they are going to reassess your, loan value and how much you can borrow. You're borrowing basically. So a buyer maybe who had an approval to buy a property of $1.5 million, now he can afford $1.2 million of property. So definitely he has to change the markets. He might not be able to buy any more in the eastern suburbs or in Parramatta, and he might have to go to Marston Park to afford a property in Sydney. So that shift is happening, and especially in the area, and even I'm seeing this in the areas around Gold Coast, Brisbane, where I would say this is more of a buyer's market now. You can negotiate 10 to 15% on the property prices. Depends on, if the seller is really keen to sell the property. So that shift is going to happen, and especially in the higher markets. And that's what we are seeing in Sydney.
And will there be any shift in apartments here? Like, how the apartments has always been the last preference for most of the people to buy, unless you are buying to live in, like investment. Is the investor market going to shift towards more apartments now?
Yes, it will. I still see that, again, because of the affordability reasons. And this is about the mindset. My personal mindset is always go for a land. I don't prefer buying an apartment or a unit, but then there are a lot of investors. There are different reasons for that. Apartments are good in certain areas, and the dynamics are different when you talk about apartments. Cash flow is good there. So definitely we see more sort of investment towards apartments and units, even townhouses. So that's something which might pick up specifically in the areas like Sydney, Melbourne.
So let's do a very quick thing, okay? With so many things that we discussed now, is the properties is going to go down because the borrowing capacity is low, people cannot afford, or is it going to go high because people should go for the new properties? So it's so many things. So what do you feel like is property market going to do? Is it going to go up or is it going to go down?
Yeah, very common, good question. Everyone is asking the same thing today. So my take on this is, property markets above $1 million will see a small moderation, even a little bit of fall or stabilization for next 6 to 7 months. But again, property markets at 600, 700K, they are, because the entire investor activity will be going there. There are a lot of people with a lot of cash and a lot of borrowing and everything. They are flooding these markets. Cheaper markets where the rental yields are high, they will definitely, you will see growth there. So that market research becomes more important here. Like I said, higher markets will see a slight moderation. So that's the thing that's going to happen. Another thing, more investors are inclined towards new builds now. So that's another thing happening. Land prices going up with the Iran war and all the economy not in a good shape. We are seeing that the cost of construction is already
Yes.
going high. No builders are giving fixed term contracts now, so that is a risk when you go with the new builds. But
Yeah.
then people are still taking it, and there's a premium price that people are investors are paying for the new builds. So they will again, like, market and entire property market is not going to crash. No, some markets will see moderation, and some markets will still perform 15-20%.
And how about SMSF? We never spoke about it because
Yeah.
things have a lot changed, but nothing changed in the SMSF.
No, yeah. So yes, nothing has changed in SMSF. It is still the perfect and great way to build your retirement.
Yeah.
So if uh, if you have 250k, 300k, start investing in SMSF. It's a very nominal 10% capital gains tax if you sell before retirement. If you sell after retirement, no tax at all till now.
Just this is the thing which when everybody is talking about these things, and I have heard this from a lot of people like Ankit, those who are property strategists, those who help us, or do you call them buyer's agent as in we call them, they have been talking about it. That this is the best time to build the property in your portfolio for your retirement. So let's not see the short-term thingy. For the long-term thing, best time. So you have been working with SMSF, you have helped. I know a couple of people, those who are very close to me, have been taking your help to buy SMSF, and they got great properties.
Yeah.
Yes. So please continue for my guest that we were speaking about SMSF.
So I think this is a good time to buy established properties in SMSF. In long term, nothing changes for SMSF. As if, see, there are a few proposals around, if your SMSF balance reaches over 3 million, there might be some tax changes and all that, but nothing is law yet. So still, it's a great way to invest. And like I mentioned, there's just 10% capital gains and 15% tax on your rental income there. So which is nowhere near what you will be paying as a CGT or as your 100%. Marginal tax. So and again, see, we do also have options of new builds under SMSF. So if someone is looking for new properties in SMSF, that can also be done under one contracts. So yes, SMSF is a great way of investing. Talk to your accountant. And
talk to someone like you.
Talk to someone. Yeah.
No, that's a fact. I always appreciate this. Investing the most cheapest thing in the world is information now, and the most valuable thing is your time. If I'm going to invest my time in getting information which is already available with somebody else, then why not I pay for that information, or why not I involve that person for the information and save my time to use for something which would give me much more better result than investing my time in doing the research that would take me long ages. By the time I reach my conclusion, the market is already saturated. Then I move again to another research. I have done that. So I know that it's really great if somebody takes help from people like businesses like you instead of waiting for saturation. And as you said right now, that it is not yet anything law in the SMSF. The funny thing is, you always get grandfather rules in Australia. So best invest now. By the time the law come, you're already grandfather.
Absolutely. And see, like you were mentioning, taking help from the buyer's agent or paying the buyer's agent or experts, it actually brings a lot of value.
100%.
Most importantly, because the market still shifts and the market shift is real. I have seen people, who thought, okay, I will do the research myself. They take 6 months because everyone is busy. It's not that you don't want to do it. It's about getting that schedule, taking out time from your busy schedule, kids and everything. So, and you take 6 months, and by the time you find a good property, it's already 50,000, 60,000 above your budget. So you have to do the research again. Rather than, why not pay a small amount to the buyer's agent, and then he'll do everything for you. So
100%.
Definitely, I mean, this market is shifting, and with all these changes, the role of experts become very important here.
100%. This is what you guys bring to the table. And then I would tell you an example. Same street, same time, almost two people bought, and I'm saying it from experience. One house almost paid 50 to 60k extra. The next house bought 50 to 60k less. One through buyer's agent, one not through buyer's agent. But then again, when you're selling the house, it comes off your tax, the payment, and all these things. But I could see that's when we started engaging, because we could see the difference.
Yes.
And we were like, okay, this is the time we need somebody expert to help us. And with this new shift and everything, we don't know what to do. So I better take an expert's advice.
Yes. And see, it's not only about the area research, it's about the long-term potential on the property that we research
100%.
as well. So there are a lot of clients who I work with, and what we are doing, I always prefer buying a bigger land, which has future potential. So we do that initial due diligence as well, to make sure you get the future potential. You could extract the future potential from that land you've got or property you've got, putting a granny, because see, accelerating your yield is going to be very important now going forward. In order to make a positive gearing property, it's very difficult with the current interest rates, 6.5%, 7% with the trusts and all. So you can't find a residential property with 8-9% of rental yield. That's not possible. So how you make a property positive gearing? By putting a granny at the back, but then you should have done that due diligence before you buy a property. There should be enough side access to put a granny, and there should be enough connection, sewerage, and basic things that we could do. So we do all those things, and that is something you realize 2-3 years down the line. Oh, that it's good. I got a property. This property, I can put a granny. It's just about 150-200K, and my rental goes up by 500-600 per week.
100%.
So which is huge. And the value of the property goes up as well.
No, that is 100%. Also, Ankit, tell me about what should the youth do now? Because for them, entering the market, like if I'm looking at somebody who is 28, 29, has been looking or putting some amount to buy a house, to enter the market early, all these things. So how are you being able to deliver that knowledge to them? For that generation, because 28 to 35 is the biggest one. I feel they are affected also. Though high earners and negative gearing, investors are affected. But I feel this is also the group that is very confused. To my audience, for this particular section of people, tell what kind of strategy they should look into now.
See, again, like I mentioned, the fundamentals of property investment have not changed. It all comes down to your borrowing. Say you are a single income earner, you have limited borrowing. My personal suggestion is going for the options like rent vesting. It depends on the different demographics you come from and all. So we think of buying our own house first and then go for investing. But then if you have limited income, limited borrowing, then and you go for your own house, then that's what limits you. You can't then you just pay off your house for the rest of your life. Because the interest rates are so high and EMIs are so high, you can't even save money. But then if again, like if go for investing, start investing in a property straight away in the locations where you can afford, and live where you want to live in good locations. You can pay a little bit higher rental, that's okay, but you're still getting rental from the other property. You are still able to grow on that capital growth. See, one of my client, I would say client partner, we know each other from 2020. So he was a single income earner. He came from India. He had an option to, like, he had that time he had a borrowing of around 700-800K. He could have bought an apartment in Sydney. He could have got a house as well somewhere little bit towards Penrith, but he opted to go for a house and land package in Gold Coast that time. And he built his own portfolio of 11 to 12 properties from that in next 5 years. Wow. Only he was a single income earner. He got cheaper properties and built his portfolio. And I recently went 3 weeks back to his housewarming. He was able to sell few of his properties, get $1.5 million of cash, and he got $2.3 million of house in Kellyville.
Wow, why not? So wow, that's a great one.
It took him 6 years. You see, I agree. The market was different. The COVID boom, because of COVID, the boom happened, but it doesn't change the overall, history of Australian property market. We see a 6 to 7% growth.
Yep.
So maybe instead of 5 to 6 years, you might be able to double your property in 10 years. But after 10 years, if you can afford a property in Sydney with $2, $3, $4 million, by making all that money, instead of taking all that stress now, go for rent vesting.
100%.
It's a great way.
No, this is a very good knowledge. I came to know this very recently, like last 5 years. But if I had known this, we would have done rent vesting starting with.
Yes.
Buying is great. Having your own house is great. Kids were young. It was all great. But if I would have invested a lot outside in the outskirts that time and would have got now.
Yeah.
So the thing would have changed.
Yes.
The whole scenario, the section would have changed. We understood it quite after 5, 6, because we live in a situation, in this environment where everybody is like, we live in a house, we live in our own house. You can put something on your wall. This kind of things, it keeps on nagging in the brain. But if you see property growth and you see a long-term growth, which you just said now, that investing somewhere where you can afford and investing multiple where you afford in next 5, 6 years, and using that to be in a house that is in mortgage free, and then again build another time portfolio for your positive cash flow, or change your strategy and do that. That's amazing. And that's what anybody who is right now listening, and if you have young kids, those who are in your 20s, you want to tell them, this is the best nugget of information that you can give them, is build portfolio somewhere, wherever you want to live, that's fine. Build it where you can and re-strategize after 5, 6 years, looking at market conditions, looking at your situation, re-strategize. Maybe you will have a house which is free and earlier than your parents.
Yes. And see, one more thing I want to add here. Your first house in Australia is never your last house. That's what I have seen. In fact, I have seen that people buy a house, big house maybe in the western suburbs, and they are paying a good mortgage on that. 3-4 years down the line, now their kids want to go into the good high school. Maybe they didn't, even if they go through the selective and all, the high school is in an entirely different area.
Yes.
They are shifting houses and going into apartments and putting their, freestanding house on rent.
Yeah.
So why to go through that trouble?
Your best example is sitting here.
There you go.
We put our house.
You're still living on rent because of your kids.
Yes.
So,
and it is also a big change to your lifestyle. That when your kids, whichever stage you are in your life, as you grow, that's what I said. Every 5, 6 months, you need to re-strategize, and you should have somebody, property strategist like you, who can help you understand that process, a journey, what you need to be. It is great. Give me a takeaway today to my audience. Any takeaway that you feel like, because I know it's a chaos. I know everybody is talking about what to do next. Everybody has somebody who is their friend and family helping them. And trust me, no offense to friend and family, but you need somebody who actually has knowledge to help you. But anything that my audience can take away today?
Yeah, I think the biggest takeaway is that do not let the tax changes, impact your investment strategy or, influence your investment strategy. These things keep on happening. They come and go. Even these announcements are not yet, legislated. There are still a lot of discussions that are supposed to happen. There's a lot of the opposition still, do not want these things to be legalized. I would say about legislated. So the fundamentals of investing have not changed. The mechanics have not changed. In the long term, things will not change. Important thing to understand is stress test your borrowing and how much you can basically, the cash flow that you can afford by buying a property. Those things need to be done before you buy a property. Make sure you buy a property which you can afford. Talk to an accountant before, because he knows the full picture of your income and everything. So talk to him before buying a property, make a proper strategy before getting into the game. So these are the things you need to, now do before investing rather than not investing at all.
100%. Yeah. That was absolutely pleasure you. I loved the way you made Michael a great example. Yeah. And I will definitely put those things that you told right now when you are speaking. But thank you again. It was really great having you in this chaos, bringing the calmness.
Thank you so much for having me, Alka. And I hope the viewers, listeners will get something out of it. And it would clear some of the confusion around all the changes that are being proposed and that are being announced at this stage. If you're still looking, for more details around your individual situations, we can connect one-to-one, and we are always ready to help or educate. Even if you decide not to buy, not to go with a buyer's agent, but still getting that information and knowledge is something that you should definitely do.
100%.
Give me a call or drop me a message, and I can just provide you all the information that you need.
And Ankit's detail will be in the description for always to connect. And do connect him over his Facebook and Instagram, because he really says good information there. Thank you.
Thank you so much, Alka.